Hi there, business owner. Are you looking to improve your business knowledge? Do you want to see behind the scenes of successful businesses? And more importantly, are you looking to build a better business in just 15 minutes each week? If so, you're in the right place. Welcome to the 3Bs podcast. Hello and welcome back to another episode of the 3Bs podcast, your go-to 15 minutes to help you build a better business in 2025 and beyond. Now, I wanted to start because it's January and to talk about tax return season. This episode and the next three will all be about tax returns to help you as that deadline approaches. If you don't know, the deadline to submit and pay any tax due is the 31st of January each year. Now, right now in January 2025, we are in the 23 to 24 tax return window. So that is for all income and tax affairs from the 6th of April 2023 to the 5th of April 2024. So there's going to be a bit of a who, what, where, why, and when. Oh, by the way, if you don't know, hi, I'm your host, Stephanie, and I'm here every week to help you build a better business. So let's get into the who for today. Who needs to submit a self-assessment? Well, that varies. Most people need to submit a self-assessment for self-employed reasons because they run a sole trader business. But as business owners, we're not the only ones that need to submit self-assessments each year. There are many other reasons why you may need to submit a self-assessment tax return, and the individuals that need to submit these can be any or all of the following criteria. So, self-employed business owners that earn more than £1,000 will need to submit a self-assessment tax return. Now, a self-employed person means you're either a sole trader business or you work for yourself. That does not mean that you have a private limited company. That is dealt with separately in a corporation tax return. The personal income you take from that corporation may need to be submitted to a self-assessment if some of the criteria apply. Importantly, the self-employed earning over £1,000. So there is an £1,000 threshold called the trading allowance. So if you are self-employed and you earn £1,000 or more in a tax year, then you need to submit a self-assessment. If you earn £999 in the tax year, you can use what's called a trading allowance, which means you do not need to register and declare that earning on your self-assessment unless other criteria apply. So if none of the other things apply and you make things handmade for a business and you've sold £999 in a year, you do not need to submit a self-assessment. If you are a partner in a business partnership, a self-assessment will need to be completed because a partnership is similar to a sole trader in that it is linked to you personally and not a separate entity like a private limited company. Also, individuals who earn £150,000 a year or more across their different income sources will also need to submit a self-assessment in most cases. That is because the tax thresholds change, and when you get over £100,000 a year of personal income, it starts to reduce your tax-free personal allowance, which currently is £12,570. That is then reduced once you go over the £1,000 threshold, affects the amount of tax that you need to claim. Therefore, a self-assessment is completed to make sure that the correct amount of tax has been paid or is to be paid each year when you add together your income tax, national insurance, capital gains tax, and those with income or sales of assets that are not taxed at source. These things can often fall through the little gaps, and that is why they ask you to submit a self-assessment. Also, any individuals wanting to claim certain income tax or capital gains tax reliefs will need to submit a self-assessment. Capital gains tax is the profit gained on the increase in value of an asset that you own. So, for example, if you have multiple properties and you sold a second property, then the increase in value of that property, the profit you would make on the sale of that asset, would be liable to capital gains tax. But we will go into that in more detail in a future episode. Another type of person that will need to submit a self-assessment is landlords earning income from letting properties. Landlords have many different rules to those who are submitting self-employment under different rules. So if they run a business and you make something or you provide services as a sole trader, landlords often have very different rules and different tax laws around the way that tax is calculated and treated. Therefore, landlords who earn income from letting property do need to submit a self-assessment each year to make sure that that tax is calculated correctly. Earnings from tips and commission is another one. This is really common if you are somebody who receives tips and commissions, maybe in the hospitality industry. So if you work in a pub or a restaurant and you receive tips or commission that are not handled by a trunk scheme or through your employer, then earnings from tips and commission may need to be included on your self-assessment. The next one is catching out a lot of people, especially when the interest rate rise, and that's income received from savings, investments and dividends. So if you're a director of a UK limited company and you take a dividend, that needs to be declared on a self-assessment. Also, if you have any income from investment, so more and more people are investing in NFTs and crypto and things like that, currencies, those sorts of investments, or stocks and shares, any income received from them investments needs to be declared on a self-assessment. And savings. So if the interest you receive from your savings is over £2,000 in this tax year, you will need to submit a self-assessment. And this is where we're coming across more and more individuals who haven't had to submit a self-assessment before and now having to submit a self-assessment because their savings are getting more interest, especially when the interest rate really peaked when inflation was all over the place last year. That has meant that people that have maybe been saving for a long time, that are getting close to pension age, are now hitting that threshold for the interest on their savings and having to submit a self-assessment. And it's our job as bookkeepers and accountants to ensure that we help and guide those people who have never had to do it before, who may be quite anxious and fearful and not understand that they have to submit one, why they have to submit one, or when, because they've never had to do it before. Income from an overseas source is another one that needs to be declared. I have clients who have shares in Swedish companies and receive dividends in Swedish krona, and that has to be declared on their self-assessment tax return. Also, people are getting income from an overseas source. Maybe they have property that they rent out over there, maybe a holiday home or a villa or something like that. Income that comes from an overseas source will need to be declared on your self-assessment. If you listen to the episode a couple of episodes from now, I'm going to go through why you should get them submitted early, why it's a real benefit to get them in and not wait until the deadline. But we do understand that there is many clients who sometimes can't do their self-assessment until later in the period before the deadline, and that's because maybe they have multiple jobs and they're waiting for P60s. Clients who receive pensions, they have to wait for the P60 from their pensions provider before all that information can be put into the self-assessment tax return. But the earlier is definitely the better, and I will let you know how and why in a couple of episodes' time. Individuals who receive child benefit with income exceeding £60,000 will also need to submit a self-assessment because that makes them liable for the high income child benefit charge, where a portion or a percentage of your child benefit will need to be paid back if your income exceeds £60,000. What's really important to note here is income exceeding £60,000 is looked at in different ways if you're employed versus self-employed. If you're employed, that's £60,000 gross on your payslip, so £5,000 a month before tax on your payslip. If you're a sole trader, that income of £60,000 is actually your net profit, so it's after your expenses have been calculated. If that figure is then over £60,000, the high benefit charge applies. If you're concerned about the child benefit charge or any of the things we're talking about today and not sure if you need to do a self-assessment or not, do get in touch with us at ABCS UK. I will pop the link in the show notes. We can point you in the right direction, and if we don't have capacity to help you, we have a network of incredible accountants or bookkeepers that can. And finally, if you are a non-resident and you have taxable income in the UK, including non-UK resident landlords, a self-assessment still needs to be submitted to the HMRC. So this means that if you live in another country but you have taxable income in the UK, that needs to be declared on a self-assessment. I know that this is changing. The Chancellor of the Exchequer did announce that this would be changing, but for right now, this is as it was before the announcement at the autumn statement. So this is not an exhaustive list. There are lots of different types of people that are required to complete a self-assessment tax return. And maybe you are one of those people but don't need to submit a tax return. There is a calculator you can use on the HMRC website. Again, I'll put it in the show notes for you so that you can go on and check it yourself. Any queries, do get in touch. We are more than happy to help you. I also wanted to note that the deadline is the 31st of January 2025, which is less than 30 days away now. So if you're listening to this when it's released and you haven't done it yet, please get on with it. Please do it. If you need any help or support, there's many bookkeepers and accountants out there helping people with capacity still. So let's summarise the necessary deadlines for the 2023-2024 tax year. So, as I said earlier, the tax year runs from the 6th of April 2023 to the 5th of April 2024. If you needed to register for self-assessment within that period, you needed to have done so by the 5th of October 2024. So if you are starting a business now or you're new to starting as a sole trader, you will need to register for this tax year by the 5th of October 2025 in order to not get any penalties. Midnight on the 31st of January 2025 is the deadline for submitting your online tax return. Most cases now you cannot submit a paper tax return, but it's worth noting that if you are one who can, that has to be submitted earlier, which is the 31st of October following the tax year. So in this case, it was back on the 31st of October 2024. And alongside the submission of the online tax return by midnight on the 31st of January 2025, the HMRC also needs to receive the payment of any tax due by there, as well as the first payment on account if you are eligible. So if your tax liability is over £1,000 for the 23-24 tax year, you will be asked to pay your tax that you calculated for this tax year plus 50% of that again as your first payment on account towards your 24-25 tax year. It catches most people out because it gives you a much higher tax liability at the beginning. If you miss any of those deadlines, if you file late, if you pay late, if you miss the payment on account by that deadline, then you will receive a penalty. There is a failure to submit penalty. There is also a failure to pay penalty, and then interest goes on that failure to pay penalty and the outstanding tax liability on top. I'm not saying this to scare you, but as a business owner, it's important that you know and take responsibility for these taxes. It can be scary, and do seek advice. Come and contact us if you need to speak to somebody about it. We can help you, but you need to be aware of these because the penalties can creep up very quickly. They mount up really fast, and I don't want you to worry, stress, or struggle with any of this. A good bookkeeper or accountant will meet with you quarterly as a minimum and get you prepared to start putting money aside for your tax return or give you an idea of what your liability will be, and also let you know when the payment windows are due. So for our clients at ABCS UK, that we've already completed and submitted their self-assessment tax return, I have sent them out a reminder at the beginning of January to remind them that the payment is due and how much they're due and how to pay it. It's really, really important that you take into consideration any days that it takes for the money to be received, because it's not enough for you just to pay it by midnight on the 31st of January. HMRC need to have received the funds by midnight on the 31st of January in order to avoid any penalties or interest. If you're paying online via online banking on your phone or by credit or debit card, that's usually within a couple of hours, so that's not a problem. If you're paying by direct debit, it's usually 3 to 5 working days. But if you've pre-set up the direct debit before the window, that it's the time the payment is due, even though the payment may come out a couple of days later, you won't be charged for that because they've submitted the direct debit on the day. If you're paying by cash, by cheque, going into a post office to make that payment, it's 3 to 5 working days for that to be added to your account. So you need to count back 3 to 5 working days, 5 to be on the safe side, to make sure that your payment arrives with the HMRC on time. And that brings us to the end of another episode of the 3Bs podcast. I hope it's been really useful for you and you have a better understanding of who needs to submit a self-assessment. If you have any queries, do let us know. My links will be in the show notes for you. If you are listening to us on a podcast platform, please do like, rate, review, subscribe, share with your followers. And if you're watching us on YouTube, it really helps the podcast to reach more business owners so I can help us all to build a better business. Join us next week for the next part of self-assessments and the expenses that you can claim and things to remember when offsetting your tax liability. See you next week for the next episode. And that brings us to the end of another episode of the 3Bs podcast. Thank you so much for listening. Please connect with us on social media. like, rate and review wherever you are listening to this podcast so that I can help more business owners build a better business. See you next week.